Welcome back to John Orther's Note. The International Monetary Fund created quite a storm last week by publishing research suggesting that governments had underestimated the impact of fiscal austerity on economic growth. This really stirred the debate in Europe about whether governments in southern Europe had gone too far in spending cuts and tax increases. But was their methodology so good? Chris Giles, the FT's economics editor, has questioned some of the results, and he's here to discuss them with me today. Chris, if we take a look at the first chart we have here, this is what the IMF gave us last week. Tell us, what's this chart showing, or supposed to be showing?
Well, on the horizontal axis, what you can see is countries' desire to consolidate their budgets, their desired austerity in 2010. So countries like Greece on the right were planning to do a lot of austerity. Germany on the left, not very much. In fact, a bit of stimulus, the IMF thinks. And it sort of says that countries that planned lots of austerity seem to be very disappointing. Their growth outcome is not how much the economies grew, but it's how wrong the IMF's forecasts were. Seemed to be much bigger, the IMF said, in countries that were trying to do more austerity. So it decided that its own forecasts were wrong in 2010.
These are the growth forecasts on the left-hand side.
Now, these are the differences between, this is the error in their growth forecast. So countries which didn't do much austerity, the IMF sort of underestimated how well they would do, and countries that did lots of austerity or were planning to do lots of austerity, the IMF was too optimistic about.
And that nice straight line down the middle seems to suggest exactly that relationship.
It seems to, that's what the IMF
said.
So
what's your problem with this analysis?
Well, I can't quite do it here, but if you just stick your thumbs over Greece and Germany, or your hands, you would see that that sort of very nice relationship begins to disappear a bit. And then so I got all the data for that year and for other years recently and shoved it into a statistics package to see whether that result sort of was robust, could stand up when you just change some of the assumptions.
In fact, we've got another chart. Our second chart is one you've put together. Tell us what's the difference between this chart and the previous chart.
Well, it's basically exactly the same chart. You're doing exactly the same thing, but you're just rolling everything forward a year. So these are the 2011 forecasts for the years up to 2012, because we've got all the data essentially for 2012 now. And as you can see, there is no relationship whatsoever. So if the IMF's result was a general result, not a specific result to the 2010 forecasts, then you should have seen the same thing here, but you don't.
So it's the same axes, but where would you put a straight line?
Well, if you actually had to, there's nothing statistically significant in this at all. So you wouldn't, if you put a straight line anywhere, you'd be doing something really quite dodgy. But if the actual result is pretty much a horizontal line, no slope.
Okay, so what does this mean? The IMF got it wrong?
It means that, it doesn't mean the IMF is wrong, but it means that they might be right in that fiscal austerity might be having a more important effect, but they haven't proved it at all, and what they showed was not proof of that.
So Chris, of course what matters is what does this mean for fiscal austerity packages in Europe? Are they going too far or not?
Well, I don't think you can actually say whether they are going too far or not from this data. That's the sort of the point. This data doesn't really prove anything, and the IMF has some other rather good reasons why maybe the European fiscal packages are going too fast, in that the Eurozone as a whole doesn't have a fiscal problem, nothing like as big a deficit as the UK or the US or Japan. And so why is that the area of the world which is really ramming on the austerity?
Well, presumably it matters your starting point, and presumably the cultural characteristics or economic characteristics of a country as well.
Yes, I mean the real difficulty is if you're Spain or Italy, is that you don't really have a choice in the Eurozone, because you can't finance yourself and you can't finance much bigger deficits. So it's really, this sort of analysis doesn't tell you what's actually going on in individual countries, and for that you often have to look a little bit more carefully at the specifics of the country. And then the moment you start telling stories about one country or another country, and this is what they're doing and this is why the outcome has been the way it has, then you've really lost all of this in the first place.
Of course, this is of great importance to people without jobs in Europe, people looking to see how the Eurozone develops over the years to come. I think this is a debate that's going to run and run.